You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have LVMH, Airtel Africa, Pets at Home, Patria Private Equity Trust, Shell, and our US company of the week is PayPal. Sam, shall I kick us off with LVMH?
Absolutely. Favorite of the show.
It very much is. In terms of the background to LVMH, for anybody who doesn't know, it's the group that owns Louis Vuitton, Dior, Moet, Hennessy, Tiffany, Bulgari, and many more. It's probably got the best collection of luxury brands in the world. They had their full year results out, with full year revenue rising by 1% on an organic basis to 84.7 billion euros. Declines in fashion and leather goods, which account for nearly half of total revenue, was offset by growth in selective retailing and perfumes and cosmetics. Operating profit fell by 14% to 19.6 billion euros, missing market forecast of 20.4 billion euros. Profits across all divisions fell, including a 10% decline in fashion goods and leather, which was exacerbated by faster declines in wines and spirits and watches and jewellery. Free cash flow rose from 8.1 to 10.5 billion euros due to lower operating investments, and net debt was 31.4 billion euros at the year end. In January 25, some brands, including Louis Vuitton and Tiffany, are already seeing double-digit growth. Markets are forecasting full-year revenue growth of 5.6% to 89.2 billion euros. A dividend of 13 euros per share has been announced, which was in line with last year, and the shares were down around 6% in early trading. In terms of valuation, LVMH has a market cap of 248 billion euros and trades at 26 times forward earnings, compared with the 10-year average of 23.5, and it has a prospective dividend yield of just under 2%. I thought these results were disappointing. I think we have got used to things moderating a lot with LVMH after a couple of years of strong growth. There is the difficult macroeconomic backdrop in China, and I think that is partly accountable for these. We've seen it with Burberry, but it's not as well. LVMH, I think, at that more premium end, it's not as severe, but still disappointing. I think there are glimmers of hope there with Louis Vuitton and Tiffany, though, and I think in the longer term, it, as I mentioned earlier, it does have the best stable of premium brands. And I think even when we're experiencing more difficult times as we are now, it's still probably the best of those designer fashion companies to buy, in my opinion. And I think in looking at the valuation, I think it's still fairly pricey, but I think to get a company like this, it's one that you look to hold for the very long term. And I think in the very long term, it will continue to deliver above market returns. But I think in the shorter term, we're looking at full year revenue growth of 5.6%, not what you'd hope for at the current valuation. But I think longer term, especially when China picks up, that we get back to the higher single digits. Sam, what are your thoughts on these results from LVMH and the future of the business?
I think they're disappointing, but we've covered them throughout the year, and we've known this was coming because the interim results were pretty disappointing. And I think it was pretty obvious from the guidance this was going to continue. I don't know what's going to happen in the short to medium term with the business. I think there's an element of cyclicality. They've had a few very, very good years. In the long term, I would absolutely back them. I just think with that portfolio of brands, and then probably got quite a lot of long-term demographic tailwinds in terms of rising middle class in, China, for example, and take your pick of whatever other countries. I just think they've got so many brands that they're so well positioned for the future. It's not like with Burberry, like you mentioned, where they basically just have Burberry. And depending on how the marketing goes and the brand perception and how that changes, it all rises and falls. The fate rises and falls with one brand. And LVMH doesn't have that problem because it's just got so many high quality brands. Where I struggle is the price, because The share price has come down a bit. However, as you've pointed out, the valuation hasn't. So we're on reduced earnings, but it's kind of maintained the same PE, but that PE is just the actual price is reduced with the earnings. But I think for the figures it's putting up in the year it's had, sort of 25 times earnings or whatever it is quite expensive. It's a business I'd really, really like to own. And I think it is a business on my watch list, but unfortunately, I think it is also a business that because of the quality, this could be on the watch list for years. I would like to own it, but
Is
I
it?
couldn't. For a business that's what did it grow revenue 1% a year
Yeah.
at 25 times earnings, I just, although I do really like it longer term, I don't see how I could justify paying that.
Is there a price at which, you'd have in your mind that you would buy shares at?
I think if I could get it at a PE below 15,
Okay.
I'd seriously consider it. But the problem is, it's because I just think
Yeah.
I struggle to see it growing more than 10% a year.
Yeah.
I
Yeah.
think
Yeah.
even 10%, I think it would, without acquisitions, I think it would do very well to hit 10%, given that although it's got really high quality brands, they're also fairly saturated. And although they do have sort of longer term tailwinds, I actually think if they could do mid single digits long term, I think that would be a good result.
Yeah.
So I think when you consider that sort of, I'd say 15 is about right, really.
Yeah.
Sort
Yeah.
of 10 to 15, but probably at the upper end because of the quality of the business. But at 25, unless you're just factoring in at some that this is a business that might always trade for a premium because of the quality of the brands. In terms of like what the business is actually going to do and the cash it will generate, I don't think I can justify paying 25 times earnings. But I'm assuming you're in a similar position because it's the kind of stock that would sit quite
Uh,
well in your portfolio.
yeah, and I would love to own it, but I think that was it's the same difficulty. It's paying up for it. And yes, of course, if it was 15 times earnings, it's sort of a no-brainer to buy, but it never is 15 times earnings, and it probably never will be. So that I suppose that's the dilemma.
We've had businesses before where we've followed them for years on the show and they do trade at a premium and then they have a blip for a year. It's like with these set of results, it might just be a blip in a bad year, but if you get another year or two of this, that's
Yeah,
probably going to affect the multiple. And I think at that
yeah,
point, as long as you've got that longer term belief in the business turn, it's a bit like Diageo, isn't it? That's always been a stock that trades at a P of sort of 25 to 35.
yeah,
And then actually that's
yeah,
come right down in the last few months.
yeah.
But for the first 3 or 4 years that we covered it, you never saw it below 25.
No, absolutely. But then it was putting up the numbers, and now that it not so.
Yeah, but you need that sort of longer term belief, don't you, that it's going to get back to it and it's just a temporary blip. But
Yeah, yeah,
I
yeah.
just think unless something radically changes, if it has a couple of poor years and the multiple were to change, I'd still have a lot of faith in those brands in the same
Yeah,
way I
no,
do with
absolutely.
Diageo's, actually.
Yeah, no, absolutely.
Right.
Okay, on to one that we both own.
Yes, Airtel Africa, another one that's been testing us for the past couple of years.
Yeah.
So, Airtel Africa, we do cover them regularly, but for anyone who's not familiar, they are a telecoms business that operate in, I think it's 14 African countries, and they have come out with their third quarter results for the period ended 31 December 2024. So the operational highlights included the total customer base grew 7.9% to 163.1 million. Data customer penetration continues to rise with a 13.8% in data customers to 71.4 million. Data usage per customer increased by 32.3% to 6.9 gigabytes, with smartphone penetration increasing by 5.2% to reach 44.2%. The continued investment to increase financial inclusion across our markets contributed to an 18.3% increase in mobile money subscribers to 44.3 million. Transaction value in Q3 2025 increased by 33.3% in constant currency, with annualized transaction value of 146 billion. Data average revenue per user growth of 15% and mobile money average revenue per user growth of 11.8% in constant currency continued to support overall average revenue per users, which rose 12% year over year in constant currency. Customer experience remains core to the strategy with sustained network investment during the period. In line with strategic priorities, data capacity across the network has increased by 20.8% with the rollout of 2,850 sites and approximately 2,600 kilometers of fiber. Revenues were up 20.4% in constant currency to 3.6 billion, but declined 5.8% in reported currency as currency devaluation continued to impact reported revenue trends. Across the group, mobile services revenue grew by 18.8% in constant currency, driven by voice revenue growth of 9.8% and data revenue growth of 29.5%. Mobile money revenue grew by 29.6% in constant currency. EBITDA for the 9-month period declined 11.9% in reported currency to 1.68 billion, with EBITDA margins of 46.2% impacted by increased fuel prices and the lower contribution of Nigeria to the group. However, following initial success of the cost efficiency program, EBITDA margins have expanded from 45.3% to 46.9% in the first 3 quarters of the year. In Q3, profit after tax benefited from an exceptional gain of 94 million net of tax following the Naira and Tanzanian shilling appreciation. However, over the 9-month period, profit after tax of 248 million was impacted by 57 million of exceptional derivative and foreign exchange losses. EPS before exceptional items declined 7.1 cents in the prior period, 6.2 cents, primarily impacted by increased costs associated with the ATC contract renewal, which had no impact on cash flows. Basic EPS of 4.4 cents compares to negative 1.6 in the prior period, predominantly reflecting lower derivative and foreign exchange losses in the current period. CapEx of 456 million was 7.8% lower than the prior period, and guidance for the year remains unchanged for CapEx. And they've said that they've been consistently reducing the foreign currency debt exposure, having paid down 739 of foreign currency debt over the last year. Furthermore, 92% of the operating company debt, excluding lease liabilities, is now in local currency, up from 79% a year ago. Leverage has increased from 1.3x to 2.4x, primarily reflecting the 1.2 billion increase in lease liabilities arising from the extension of the tower lease agreements with ATC as previously announced. And following the completion of the first $100 million buyback in December 2024, they have announced the commencement of a second buyback program that will return up to 100 million to shareholders. And that's the dollar figure, and that's on a market cap of 5.3 billion pounds. Just to reiterate the mobile money figures, because that is probably the part of the business we're most interested in. The constant currency revenue change was a 29.6% increase, and that was 15.8% increase in reported currency, and that's for the 9-month period. And for the quarter, constant currency increase was 31.2%, and reported currency increase was 23.4%. And total customer base for mobile money customers was up 18.3% to 44.3 million in the period. In terms of the valuation, there are no earnings because of the issues with the Nigerian currency devaluation the past year or so. However, they do now have earnings for this quarter that are positive, so they are now hopefully not too far away from getting back to having an earnings figure. The dividend yield is 3.29%, and the market cap, as mentioned, is 5.3 billion pounds. I think these results are pretty good. The constant currency figures are excellent. They're reported not so good as we've become used to in the last sort of 6 to 12 months. However, it does seem like they're starting to turn a corner with the Nigerian lira issues, in that at least it actually appreciated in this quarter. And it seems like they might be over the worst now. And I think that's reflected in the share price as well, because the shares are up 40% in the last few months, with no obvious reason for that, because I think these results are kind of in line with what we've been seeing, albeit it looks like they are now over the worst. So as a shareholder, I'm pretty happy, and hopefully this does represent a corner that's being turned. John, what do you think as a fellow shareholder?
Yeah, I feel like we have turned that corner. And as you say, in constant currency terms, very positive. I think the growth, particularly in the mobile money, is really encouraging. And I think hopefully in reported currency terms, over the next year or two, we'll see that going in a positive direction too. Very happy holding these shares.
What do you think of the share price reaction? Because
Yeah,
there's no obvious reason why it should be up 40% in the last few months, other than I guess people were maybe a bit more negative in terms of their future outlook.
yeah, I think probably when you looked, from a valuation perspective, and then the growth that it's delivering, at least in sort of constant currency. But why specifically it's been so much? I don't know. I don't know. I mean, I thought it was overdone before with the share price coming that far back.
Okay, should we move on to pets at home?
So we've covered Pets at Home quite a few times on the show before. It's the UK's leading pet retailer. They had their Q3 trading statement out last week, and the group reported that like-for-like revenue fell by 1% to £361.6 million in the third quarter. A challenging UK consumer backdrop and particularly weak footfall from October saw the retail segment decline by 2.8%, and this was only partly offset by a 19.9% growth in the vet division, where its practices saw growth in subscriptions, visits, and average transaction values. Recently lowered full-year guidance has been reiterated, with the group expecting modest growth in underlying pre-tax profits. The group plans to return £85 million to shareholders this year through a combination of dividends and share buybacks, and the shares were broadly flat on the trading statement. In terms of the valuation, Pets at Home has a market cap of around £1 billion and trades at 9.4 times forward earnings compared with the 10-year average of 15.7, and it has a prospective dividend yield of 6.6%. I thought these results were disappointing. I know we have been getting used to this more recently with Pets at Home, and I think you probably saw a lot over COVID that was pulled forward. And now that there has been a more difficult macroeconomic backdrop and cost of living pressures, you have seen that particularly in the retail division. I think the veterinary side, and we sort of commented on the strategy before, seems to be a positive one. There is a little bit of uncertainty there with the CMA investigation in terms of pricing between the big veterinary companies. So that is, something just to be aware of if you were thinking about buying shares. I think for me, I don't think the potential for growth is huge at the moment. I appreciate it is below its 10-year average in terms of its valuation, but I think in terms of the UK pet ownership at the moment, it feels fairly saturated. And I think also with the current backdrop, I don't think there's going to be huge growth anytime soon. The CMA investigation, probably be less worried about. I think they're fairly well positioned in that sense, and they're still having fairly decent growth from their veterinary division. But I think it's overall sort of opportunity cost that would probably lead me not to go any further at this stage with Pets at Home. I think probably 5 years ago, with the benefit of hindsight, was the time to buy, but I probably wouldn't go further at this stage with Pets at Home. What are your thoughts, Sam?
I'm not sure. I think it looks quite interesting, actually. I just think, yeah, yes, it's disappointing and it's on the back of what was a disappointing set of results. But I think in the time we've covered Pets at Home on the show, it's surprised me in terms of what a high quality retailer it's been, and in terms of how, for want of a better term, Amazon proof it's shown itself to be. Because prior to actually covering this fairly regularly on the show, I wouldn't have expected it to have performed anywhere near as well as it's done, as you've mentioned, over the past 5 years. And I think the strategy that's been adopted by management has been the right one in terms of obviously they've got the very important pets program, they've got the veterinary practices. But yeah, I actually think it looks all right. I think at a forward P of under 10, which is 50% below the 10-year average, and the prospective yield of over 6% for what has proven itself to be a very high quality business, I think isn't bad. I do take your point about the saturation, but I think that's kind of priced in.
Mm.
I think where I struggle is, as you've mentioned, the opportunity cost. But I think if you were wanting something for a good dividend that was pretty reliable and probably not going to decline, I think you'd struggle to find. There are a couple I can think of, but I think you'd struggle to find many business because I think you could make a similar argument for Money Supermarket. But I think you'd struggle to find a business of a similar quality with a dividend yield of over 6%, where the dividend is actually fairly well covered. So I think as an income play, I think you could make quite a good argument for it. I think the issue for me is, like you said, the saturation. Probably actually, although I like the business and I think it is one of the higher quality retailers that we cover, and probably a higher quality retailer than I initially gave it credit for. I think for me to actually take an interest in it, it would probably need to drop further. And I think it's actually quite reasonably priced now. So I don't think that would be a realistic expectation. But if it drops to kind of a forward P of 7 or 8 with a yield of 7 or 8%, I think at that point I'd be seriously interested. But at the moment, I think the issue would be opportunity cost because I think you can get it a fairly similar valuation with a fairly similar dividend. You can get Money Supermarket at the moment, and I think as a business, I do prefer Money Supermarket.
Fine.
I know they're
Okay.
totally unrelated.
No, well, absolutely. Okay, well, on to a new one this week.
Yes, so this is the Patria Private Equity Trust. It used to be an Aberdeen trust, but they've recently renamed. So they are listed on the FTSE 250 and they have come out with their full year results. We don't normally cover trusts unless it's one that's particularly interesting, but because this was private equity, I thought, well, actually, that it's a bit unusual compared to a lot of the other trusts on the FTSE. So, in terms of what they are, their investment objective is to achieve long-term total returns through holding a diversified portfolio of private equity funds and direct investments into private companies alongside private equity managers, a majority of which will have a European focus. They launched in 2001, they're listed on the FTSE 250, and their 10-year annualized net asset value total return is 14.8%, which is actually pretty good, especially considering it's been on the FTSE. So if you compare that to how the index as a whole has performed, it must have smashed it. And as well, it's giving you exposure to private equity, which is not something you would ordinarily have as a smaller investor. In terms of what they invest in, there's a list of private equity managers that they have relationships with and ownership in. I don't really know any of them. They've got One Peak, Capiton, Triton, Beaumont Capital. They just kind of throw in names at me here, and without any understanding of the private equity market, it's kind of just a random group of businesses that I've never heard of. In terms of the investment strategy, they have said that they provide diversification across over 600 underlying private companies, and they've been increasing the exposure to direct investments rather than via the PE funds themselves or PE firms themselves. Have been trying to do it directly more, and they now represent 25% of the net asset value. In terms of the fees, they actually only charge a flat management fee of 95 basis points, so that would be 0.95% with no performance fee. I actually think, given that there's not many other ways you can get exposure to private equity, especially in a way that is so liquid, and with the kind of returns they've been putting up, I actually think that fee is fairly reasonable. So in terms of their performance for the 12 months, they've said that the share price total return was 24.9%, and that's been driven by a narrowing of the share price discount aided by a share buyback program. The portfolio return in local currency was 8.8%, and they've said that the net asset value performance was negatively impacted by currency FX with strengthening pound and the portfolio continuing to perform solidly in local currency. The balance sheet gearing ratio increased to 11.8% during the year, albeit 152.7 million of deferred proceeds are due to be received in the 2025 year from secondary sales. And they have an ongoing charge ratio of 1.06%. So I'm not sure how it goes from that 0.95 to 1.06%, but for 0.1%, I haven't investigated it. And they've sold some businesses during the year or some investments. Again, it's companies I've not heard of. Concilium Sport Group, Mademoiselle Desserts. But the average exit was conducted at an average 26% uplift compared to the valuation 2 quarters prior, which if I was making 26% every 6 months, I wouldn't be too upset with that. And in terms of secondary sales, they have in September 2024 agreed to sell a portfolio of 14 non-core fund investments. So these represent 13% of the portfolio at 31 August. And the disposal releases a combined overall return of 1.9x the multiple on uninvested capital and represent a 16% internal rate of return for the 14 fund investments. And they're selling these investments at a 5% discount relative to the net asset value, which when I get onto the valuation later, that's a lot lower than the discount you're essentially getting, you would have been getting it for had you bought the fund. So I think they've done quite well to actually negotiate such a narrow discount, given they themselves are trading at such a high one. For the underlying portfolio companies, they've said that the median valuation multiple was 13.5x EBITDA with relatively low leverage and continued strong earnings performance. So the top 10 companies make up 17.6% of the portfolio. So I'd say that's pretty well diversified actually as well. And for the top 10 companies, again, it's just a list of companies I haven't heard of. NAMSA, CFC, European Camping Group, Wundex, Gritec. But again, the top one is only 2.4% of the net asset value, so it's pretty well diversified. And the largest portfolio company exposure continues to perform well with average revenue growth for the top 10 of 13.5% and EBITDA growth of 23.3%. And as mentioned before, the portfolio consists of over 600 underlying private companies, which are well balanced across sectors and vintages. So, as an example, 21% healthcare, 18% industrial, 12% consumer discretionary, 23% IT, 11% consumer staples, 8% financials, 4% materials. And in terms of the valuation, the business trades at a 26.71% discount to the net asset value, and it also has a dividend yield of 2.98%. Obviously, we don't really cover these kind of funds very much because I'm not overly interested in investing in actively managed funds. However, I think because it gives you exposure to private equity, I think it's a bit more interesting because it's not something it's very difficult to get exposure on your own. That being said, I'm not particularly interested in having exposure to private equity, albeit if I were to do it, I would probably want to do it in a way that's as liquid as this. And I think if you were interested with this kind of past performance, everything in here suggests, from my very limited knowledge, that they seem to be doing quite a good job. And I don't think they're charging an arm and a leg for doing it either. And you would have the liquidity. And I think in terms of the net asset value discount, I know they always trade at some, or virtually always trade at some kind of discount, but I think a 26.71% discount to the net asset value when they are doing such a good job growing the value of those net assets, I think is actually quite reasonable. So, although it's not something that particularly interests me, I think if someone were to take a deeper look, I think they'd probably be able to make quite a reasonable argument as to why it is an attractive investment. So, still not for me, but it's probably a better looking fund than I expected it to be when I picked it. John, any thoughts?
Yeah, I think largely similar to you. A couple of things that I noticed was that it was mostly sort of a European focus and more weighted towards the UK. I think about 15% of the fund is sort of UK or companies based in the UK, which I think is interesting. I suppose you might argue that if you were looking at private equity, would you have more opportunities or more growthy companies in the States? But that being said, they do seem to be delivering on in the figures that you quoted. I also do quite like that the sector breakdown. As you said, it's quite diversified, 22% in IT, industrials 19%, healthcare 19%, consumer discretionary 14%, 10% consumer staples, 9% financials, and then 7% other. I think that's pretty important, particularly when you are dealing with private equity and potentially some of the volatility and liquidity that you could be dealing with. And again, as you highlighted, the discount to the net asset value, I think, is somewhat attractive. So I think it's interesting. Probably not for me, but if I were looking into private equity, this would certainly be one that I'd consider further.
I think going back to the point you mentioned about probably the most attractive private equity investments historically have been in the US. I think the issue is that if these guys were going to go and do that, would they get access to the kind of investments they want early
Yeah,
enough? So then if you look at
yeah,
the kind of funds you would be buying, it's like a lot of these funds, they're not actually going to be interested in having a conversation with you
yeah,
because you're just
yeah,
going to be a small like you're too small for them if they're
yeah,
even open to new investors anyway. But I think the issue, that's the issue in America, that it's kind of my limited understanding from what I know about the private equity sort of space in America is there's a few absolute titans that kind of get the lion, like, they get first dibs of basically everything, and then you've got kind of lower tiered firms that are kind of fighting over everything that's left. So getting the
yeah.
actual exposure, and as well to find one with that kind of track record that you can just go and buy on the market at a discount, I think you'd really, really struggle. So I think it's
Yeah,
partly what's available.
yeah. No, no, and there's a fair point, and as you say, reflected in the valuation.
Right. Shall we move on to Shell, a business you used to own but
I used to own,
no longer do?
yes, no longer do. So I haven't owned it for probably a couple of years now. It's not as painful now when we cover it. And actually, their Q4 statement that was out, well, I'll come on to it. So revenue fell from $78.7 billion to $66.3 billion. Underlying profit halved to $3.6 billion and falling short of analyst expectations too. The weak performance reflected lower margins in its trading business as well as the marketing division. Lower oil prices also played their part, as well as non-cash write-offs for the exploration of wells. Free cash flow improved by $1.8 billion to $8.7 billion, reflecting both strong cash generation in the business and lower investment outlays. Net debt fell from $43.5 billion to $38.8 billion, and investment expenditure is expected to fall in 2025, but no specifics were given. Upstream production in the first quarter is expected to be similar to levels at the end of 2024, and sales volumes in the marketing division is the same. However, integrated gas production should increase as the Pearl gas to liquids plant comes back on stream. Refinery and chemical plant utilisation are also expected to improve. Quarterly dividend was raised by 4%, 2.35 cents per share, with a further $3.5 billion set aside for further share buybacks before the first quarter results. And the shares were broadly flat on the statement. In terms of valuation, Shell has a market cap of £159 billion and trades at 8.4 times forward earnings, compared with a 10-year average of 11, and the dividend is currently around 4.8%. I didn't think these results were too bad. I think given where the oil price is, it's basically been expected. I don't think there were any surprises. Still generating a huge amount of cash, and I think the valuation, it's still pretty cheap. I think if you look at it compared with its US peers, it's certainly very cheap. I know I'd had sort of political worries with Shell and how it was sort of being treated in the UK. I think they're still there, and they're sort of, kind of still valid. I suppose one thing that's just become increasingly clear is that companies like Shell aren't going to be investing in the North Sea anymore, but I suppose most of their revenue does come from overseas. I think they probably would command a higher valuation, and certainly when they are putting up pretty decent results if they were listed in the States. So I think there is a value element there. Yes, as we've discussed before, it's a company or an industry that's in structural decline, but how long are we going to be dependent on fossil fuels for? I think there's an argument a bit like with the tobacco companies that there's still sort of value here, and that it's going to be quite a lot longer before it disappears. I think bringing that home is what's happened in terms of Ukraine and the oil price since then. And Shell is benefiting from the higher oil prices than we'd seen when we covered this business sort of first starting the podcast in 2020, when there was sort of a glut of oil relative to the demand. It really felt like we might have reached that stage, but I think since then, it's really proved that we're kind of nowhere near, and particularly highlighted with everything that happened in 2022. So I probably wouldn't be buying shares, but I think you could, do a lot worse. And whilst the dividend yield isn't as high as it has been, it's still pretty good. Sam, what are your thoughts on Shell and these results?
Pretty similar, but I take your point with the comparison to tobacco, but my issue would be that firstly, it's a lot more capital intensive than tobacco. And secondly, it's politically much more of a target, which I guess is odd. Well, I suppose tobacco, it's obviously they're getting absolutely smacked with taxes all the time. So it's kind of just factored in. But it's only more recently that companies like Shell have become more of a political target. And I think for me, that would be, since you've sold, I don't think that's changed. It's probably not gotten worse, in fairness, but I don't think it's changed. So I think that would still be enough for me, despite the fact that I think at under 9 times earnings. I agree with what you said. I think what's happened in the last 5 years has shown that we're going to be using oil for a little while yet. And at 9 times earnings, we don't need to use it that much longer before it's kind of had already generated the earnings to pay for itself. So I can see why someone would make an argument for it, but I think there's a couple of things for me where I just wouldn't touch it because of those concerns.
Yeah, I think coming back on the political point, I think they were in more of a perilous position a couple of years ago. I think actually, since there's been more of a move to the green energy, and you've seen how expensive and the cost at which that comes with, I think that's where you're sort of beginning to see a shift, and particularly, before the last election, there was a great emphasis on sort of green energy from the Labour Party, and now that they're in government, and there's that, I suppose, that reality of having some of the highest energy bills in Europe from renewable sources, then I wouldn't say it's swinging back the other way, but I think they're bringing it back in and seeing that actually some of these companies are, as you say, going to be around for a lot longer and are part of sort of the solution rather than just trying to continually bash them. Because then ultimately, what are you left with? You're left with some of the highest energy prices in Europe.
I think as well, like when they were being probably criticized the most, it's when the oil price is higher. It had to
Yeah.
come down. And I know it's silly because, as we point out on the show, they don't actually set the oil price. They just
No.
take it.
Yeah.
But when the oil price is higher, they do just seem to present much more of an easy target. And I think with that sort of slight decline in the oil price, people seem to have forgotten about them a little bit. Now, that being said, if oil spikes 50% in 6 months, I'm sure they'll be talking about them again in the Houses of Parliament. But that is, at the minute, I think that's probably taken the heat off them as well a little bit.
Yeah, yeah, no, no, absolutely. And they're still making huge amounts of profit, even if they've, its underlying profit halved. It's halved to $3.6 billion. So
It's not a bad place to
it's
be.
not a bad place, exactly. And it's interesting because I think you see sort of Shell and BP, and on their sort of, I suppose, green transition, that's slowed down a lot too. I think they're not feeling the heat as much that they need to do that now.
No. Should we move on to our US company then?
Yes, so it's your favorite, PayPal.
Absolutely. So it's a stock that I own, PayPal. I'm sure it needs no introduction at this point, but they have come out with their fourth quarter and full year results for 2024. So the Q4 highlights included net revenue increasing 4% to 8.4 billion, and all these figures are in dollars, and that was 4% on a currency neutral basis. The transaction margin dollars increased 7% to 3.9 billion. GAAP operating income decreased 17% to 1.4 billion, and non-GAAP income increased 2% to 1.5 billion. GAAP operating margins contracted 431 basis points to 17.2%, and the non-GAAP margins contracted 34 basis points to 18%. GAAP earnings per share decreased 15% to $1.11, and non-GAAP earnings per share increased 5% to $1.19. For the full year results, so not just the quarter, but the full year, net revenues increased 7% to 31.8 billion, and that was 7% on an FX neutral basis. Transaction margin dollars increased 7% to 14.7 billion. GAAP operating income increased 6% to 5.3 billion, and non-GAAP operating income increased 14% to 5.8 billion. GAAP operating margin contracted 14 basis points to 16.7, and non-GAAP operating margin expanded 116 basis points to 18.4%. GAAP earnings per share increased 4% to $3.99, and non-GAAP earnings per share increased 21% to $4.65. In terms of the operating results, total payment volume increased 7% for the quarter and 10% for the full year to 1.68 trillion for the year. Payment transactions decreased 3% in the quarter to 6.6 billion and increased 5% in the full year to 26.3 billion. Payment transactions per active account on a trailing 12-month basis increased 3% to 60.6. Active accounts increased 2.1% or by 8.8 million to 434 million. And in Q4, active accounts increased sequentially by 0.6% or by 2.6 million. For the full year, they returned 6 billion to stockholders by repurchasing approximately 92 million shares of common stock, and that is on a market cap of 76 billion. So that is quite a big figure. And they announced as part of the earnings, they've authorized a new $15 billion stock repurchase program. And that's in addition to the previous program, which still has 4.86 billion remaining that they've got authorization for. So that gives a total of about 20 billion stock repurchases on a $76 billion market cap. So that's over 25%. And for the guidance for next year, they're guiding for GAAP earnings per share of $4.80 to $4.95, and that compares to $3.99 this year. And for non-GAAP earnings per share, they're guiding for $4.95 to $5.10, and that compares to $4.65 in the prior year. So get both healthy figures, whether you take the GAAP or the non-GAAP. In terms of the valuation, the business trades at a price to earnings multiple of 18, and that compares to a 10-year average of 28. However, as previously noted, PayPal absolutely churns out cash, and when you look at it on a price to free cash flow, it's much cheaper. And price to free cash flow comes out at 11. Plus, obviously, you've got the yield, the effective yield from all those repurchases that we've mentioned. As a shareholder, I actually think the results for the quarter were a bit disappointing. However, when you take the year as a whole, I think they're excellent. I think the guidance is good. If they put up those kind of earnings next year, I'll be very happy. And if they buy back the number of shares they're talking about, I'll also be very happy. So the shares were down about 13% on these results, and I think it's because the guidance was viewed as a bit weak. But I'm not sure what was expected in terms of the guidance, but I'm quite happy with the 2025 guidance. So it's a shareholder in terms of the results. My only niggle is I thought that the fourth quarter of that year was pretty poor. However, when you take the year as a whole, kind of all the key figures are moving in the right direction. And I think at a price of free cash flow at 11, I don't think you could really ask for better figures for the year. And also in terms of the guidance, I mean, when we're talking about, if we use the GAAP earnings, they're going to be increasing, they're expected to increase about 20% next year. So I'm not really sure what the issue is here, unless I'm missing something. But
I think one of the things that some of the analysts had flagged, and perhaps why the market had been a bit disappointed, was to do with the slowing in the card processing side of the business.
is that to do with is the card processing, is that the one that's unbranded?
I think so, but I'm not.
Yes, I'd seen that, but again, I don't really have a huge issue with slowing growth anyway, because it's not actually priced for growth at this point. But as well, like if you remember 6 or 12 months ago, we were covering this and people were complaining because most of the growth was now coming from the unbranded revenue, which was lower margin.
Yeah.
And now that's doing a bit more poorly, and they're still complaining. And it's just a bit odd. But I've not gone through the mechanics of what they're expecting to make up those earnings next year. But if they're increasing earnings by 20% next year, I'm not hugely concerned about how they're going to do it. Now, that being said, I've not listened to the call, so I don't know if the CEO has said something on the call that's particularly concerning or something. But this guy's only been in there for a year, and I think the year he's had has been excellent. So I'm quite happy to see what he does in another year. But yeah, I wouldn't say I'm massively concerned about that. And because I just think it's so cheap that people get concerned about slowing growth, but it's a business that's priced as if it's actually declining, which it isn't, which is always what I find odd about it.
Yeah, no, absolutely. And I think my worry with it would just be that you've got your Google Pay and Apple Pay coming into it. And I think losing the market share to them. And I appreciate what you say that net revenue up sort of 4% on a currency neutral base and lots of cash. But that, I think that would be my worry going forward, that the expansion of those other services, and where does PayPal, I suppose, in the long term fit. I appreciate you know what you say about the valuation and the cash though, but I think that would be probably why I wouldn't go further with it.
But again, I just don't see that in the numbers that we're looking at. Because I think for me, the main concern with that is the average transactions per customer. That's probably the biggest indicator, and that's still going up.
Yeah.
So again,
Yeah.
you've got this narrative that Google Pay is sort of stealing all the transactions, but I don't know where Google Pay and Apple Pay are taking their market share from.
Yeah.
But it doesn't seem to be PayPal, because the people who use PayPal are using it more, and that's been the case for a while.
Yeah, I mean it's interesting, and I suppose I just reflect on myself and what I use. And 10 years ago, I used PayPal a lot more than I use it now. Now it's very rare, principally because of Apple Pay and that being so slick. And I appreciate I'm sort of on the Apple side of things, but equally, if you're on the Android side of things, it I don't know. What do you use anecdotally?
So if I'm out doing shopping,
Yeah,
I use Google Pay,
yeah,
but I've never been in Tesco and used PayPal in my life. So it's not, although I use Google Pay more, it's at
yeah,
the expense of my cards. So it's not
yeah.
taken away from that. Online, I tend to do, so if it's something like a holiday, I'll book it on a credit card because you get the extra protection.
Yeah.
But for everyday purchases online, I use my Chase debit card. And then what
Mm,
I'll do is I use PayPal whenever I'm given the option, because with a debit card, you've got less protection. And I kind of view it as
mm,
PayPal's adding an extra layer of protection on top of that.
sure. Because what I generally do is I'm using my card when I'm shopping online, but it's using it sort of through Apple Pay, and you know, it's, I mean, on a Mac, you just fingerprint, thumbprint, and it goes through Apple Pay, and it's
But do
so
you use
slick.
American Express for everything?
I do, but through Apple Pay.
Yeah, but you're using a credit card already.
Yeah,
So you are getting that extra protection.
yeah, I take your point. But then, do you think what you're doing is a bit more niche, and that there won't be as many people doing that?
I'd have thought so. I do agree with your point that you would expect people to use it less. But then you go and look at the numbers, and that isn't actually happening.
Yeah, yeah, yeah. No, it's a fair point. It's a fair point. Okay.
So, of the six businesses that we've covered this week, then LVMH, Airtel Africa, Pets at Home, Patria Private Equity Trust, Shell, and PayPal, which one do you like the most and which one do you like the least?
I'd go for Airtel Africa, and it's the only one of those companies that I actually own. What do I like the least? It's a bit tricky, actually. I really don't dislike PayPal, but it would probably be between PayPal and Pets at Home. I think I'd probably go for Pets at Home, would be the one I like least at the moment. But I don't think any of these companies are bad.
So, I think for me, I'd probably go with Airtel Africa that I like the most, just because I feel like although Airtel Africa is certainly not free of risk, I feel like those risks are better known and easier to kind of quantify. Whereas with PayPal, I do kind of take your point about the transactions. And although, like I said, that doesn't seem to be happening, that is a concern. And if that happens at a quicker pace than is priced in, you can lose a lot of money quite quickly.
Mm.
But at the minute, that isn't happening. So I think there is value there in PayPal, and that's partly why I like it. And I think it is a high quality business. But I think it has that potential for things to turn around very, very quickly. So I'd probably pick Airtel Africa over PayPal. In terms of like the lease, I think it would be Patria Private Equity Trust, but that looks to be a well-run fund, and it looks like they are doing a good job. So if my least favorite's returning 14% every year, I think that is quite. In fact, probably I'd probably do Shell actually. I think I would do Shell as my least
Okay.
favorite actually, because yeah, I think with Shell, it's just that those political concerns are just too big still. So yeah, I think before we finish though as well, I'd probably just mention I think the Fundsmith AGM is I think is it on the 25th of February? I think it is because it's a Tuesday. So it's on
Yeah,
the 25th of February in London. We went a couple of years ago and a few of us all met up for a drink beforehand and that before we then went to the AGM to listen to Terry Smith. It was quite a nice day out. I had a good time. We're doing it again this year. So if anyone would like to join us beforehand for a few drinks, we have tweeted the link. So if you can sign up using that link, and then if you want to just send us a tweet letting us know, we'll send you the details of where we're meeting up.
fantastic. Well, thank you again for listening, and we might see you at Funsmith.
Right. But if not, we will see you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.